I'm Pat O'Hare, Editor-in-Chief of Briefing.com's Investor Service. In this Learning Center segment, we will be talking about the P/E ratio, which is perhaps the most widely known metric when it comes to valuing stocks. The P/E ratio can be calculated taking a company's stock price and dividing it by its earnings per share. P/E ratios can be computed using the last 4 quarters worth of earnings for a company. In this instance, you'd be talking about a trailing 12-month P/E ratio. You can, however, use earnings estimates for the next 4 quarters as the denominator to produce what is known as a forward P/E ratio. And finally, you can compute a P/E ratio based on a blend of estimates that include the last 2 quarters worth of earnings and the next 2 quarters worth of projected earnings. Whatever approach you use, it is important to keep the following points in mind when looking at a P/E ratio. First, the P/E ratio should not be used as your only gauge for determining whether a stock is cheap or expensive. It provides a good starting point, but there are many other factors to consider, such as a company's cash flow, debt load, or sales. Secondly, stocks with high P/E ratios generally have higher growth prospects and by extension face higher expectations. All else equal, earnings surprises from companies with high P/E ratios tend to produce greater stock price movement than do earnings surprises reported by companies with low P/E ratios. Third, P/E ratios are not static measures. They change with stock prices and earnings estimates, so it is important also to consider a company's or an industry's growth prospects in your assessment of whether a P/E ratio suggests a stock is overpriced or underpriced. And fourth, the P/E ratio is an indication of what investors are willing to pay for every dollar of earnings. A P/E ratio of 10, for example, implies investors are willing to pay $10 for every dollar of earnings. And finally, P/E ratios vary greatly by industry due to differences in company growth rates and the sensitivity of their earnings prospects to swings in the economic cycle. In this regard, you should be looking at peer companies for comparative purposes as opposed to, say, comparing the P/E ratio of Alcoa to the P/E ratio of Google. That wraps up our discussion of the P/E ratio. Thanks for listening.